Hello, and thanks for returning to us here at Advanced Projections for our May 2021 report. Here's our forecast review. Since our last report, the administration has continued to move forward very aggressively with its agenda, most prominently consisting of a solid and proactive program of slowing down and then eventually eliminating the consequences of COVID through vaccination, as well as the passage of the rescue package of financial assistance and fiscal stimulus. A large infrastructure restoration and improvement package is still under negotiation. Vaccine doses are currently in very broad and deep distribution nationwide, with at least 45% of the population, about 150 million people, having received at least one dose of vaccine by the end of April. Full inoculations have now reached over 32% of the U.S. population. The 2021 stimulus payments to individuals have been distributed, providing a measurable economic benefit to the nation as a whole. The recent extension of unemployment benefits through the entire summer, as well as substantive payments to the bottom income half of the population, are designed to add impetus to the economic recovery. As we have said in our last 6 months' reports, Recession 2020 technically ended in fourth quarter of 2020. There have been continuing improvements in expectations for better days ahead, still accompanied by a volatile, rampant speculative excess in the equities markets, as well as elsewhere, such as in cryptocurrencies and some precious metals. Real estate prices continue to advance sharply in upper-end housing, and that trend is likely to continue throughout the summer as low mortgage rates and short housing stock supplies persist. Now there is much talk about the impact of expected inflation, where some see the expanded money supply creating a new inflationary trend, while the Federal Reserve continues to claim we will see only a temporary bump in prices. We should see figures confirming the onset of inflation sometime during the second quarter, but through the first quarter, the official figures show 1.67%, due to the exclusion of volatile food and fuel prices. We probably have all noticed price increases for gasoline, some food items, and real estate through the first quarter of 2021. April's core inflation numbers did spike up, and we expect several months of numbers which the popular financial press will claim as scary. It's not something we at AP are going to worry about yet, though. Margin borrowing hit a new record high in March, but up by just 1.1%, so its growth is slowing for the moment. The party in equities continues almost unabated, with the S&P up another 5% during April. Last month, we said there was nothing visible on the horizon that would pierce the bubbles in the equities markets, but that caution was still warranted in taking huge positions in markets that are outrageously risky from valuation standpoints. During April, the Fed, the Treasury, and the popular financial press have begun to discuss what might cause the Fed to begin lifting short-term interest rates off zero. Commercial bankers are hard-pressed to find any low-risk places to profitably commit their cash and are expressing concern. Our own take on this current expansiveness is that it contains elements from both of the past two pre-recession bubbles. Excessive market equity speculation was found in the dot-com market bubble, and excessive real estate price inflation was found ahead of the Great Recession, even though there was a much freer supply of property at that time due to speculative construction. Now we have excessively high prices in both areas. Here's the current underlying socioeconomic situation. We said last month that our expectations for COVID cases and fatality tolls would continue increasing for many months into 2021. As of now, May 10, 2021, U.S. cases reached over 33 million, an increase comparable to the 1.8 million in the previous month. New cases have declined a bit to a recent average of about 50,000 per day. U.S. fatalities have reached past 594,000, up approximately 19,000 in the past month. If we use the reliable ratio of total fatalities divided by total resolved cases, fatality rate is flat at about 2.2%, still a 25% decline in that grim statistic since the beginning of the year. Fortunately, we seem to have outrun our fourth wave in the USA as new case and fatality numbers have dropped from recent peaks, but we are still at the top of both the global lists for total cases and total fatalities. In spite of having only 5% of the global population, we still have more than 20% of the global cases and 18% of the global fatalities. But as things continue to improve here in the US, India is melting down and will likely take over the top of both those horrid lists of COVID cases and fatalities sometime in the next 30 to 45 days. Offshore, the situation is still dire in many places. There are large shortages of critical care capacities and vaccines for distribution, attributable to several errors in approach, planning, logistics, and manufacturing capacity limitations for equipment and vaccines. Globally, cases have reached 155 plus million, up over 20 million in April. At this moment, there are now more than 400 to 500,000 new cases being reported daily. Global fatalities have now solidly reached past 3.3 million, reaching far past our April prediction of 3.1 million. Brazil and India continue to show very dire and increasing stresses from the pandemic. France and Sweden also showed heavy increases. So far, the existing vaccines appear to protect against the known variants, but the new variants are appearing to be more contagious and more harmful amongst the younger folks under age 45 than the initial version of the virus. Moderna has said that they are already working on a booster vaccine to help with further protection against variants, the first such pharma company to fully commit to it. A fatality model we have been using since it was created on November 20th of last year and have been then modifying periodically shows the danger in letting the pandemic resume its havoc here in the U.S. At the beginning of March, we were still running above this original projection in terms of actual fatalities versus the model, so we would have expected to have to wait and see for another couple of months if the problem is truly being solved, as would be evidenced by actual fatalities declining below the model's curve. We updated this chart on April 2nd, 2021 and May 2nd, 2021 and provide it below. At that time, fatalities were just at the projected levels made 130 days before. We are now more optimistic about this initial improvement, now seeing that new fatality totals have truly fallen below the curve with better expectations in the coming months. This is one AP prediction that we are particularly happy to have confirmed. June results should demonstrate a clear gap between actual and the blue predicted curve. We hope for continuing rapid domestic deployment of the vaccine with some expanding public acceptance of the necessity of being vaccinated. It is fully within our expectations that some vaccination incentives from the private sector will be forthcoming from businesses for their employees, and we might see some public sector incentives in the coming months as well. While we were composing this report, the state of Ohio announced it will be entering vaccine recipients into a high-value lottery, and this is perhaps a precursor to more substantial public incentives to get vaccinated. We have also noted some further steps being taken for a return to stricter vigilance and some attempts to identify future species-leaping viruses amongst government-run health organizations, which should help in detection and containment of future potential pandemics. Now for the current economic environment. In April, unemployment levels moved up modestly to a national level of 6.1% after a very weak monthly gain of 266,000 non-farm payroll jobs, just a quarter of what was expected. We have already been anticipating that return to work gains would flatten well below a full recovery level. This is consistent with our view that job gains will continue to return slowly, taking 15 to 20 months or more to erase all of the remaining job losses created by the pandemic. Many of those old jobs are now permanently gone, and newly created ones will be required to fill in the gap. Many businesses are reporting an inability to fill newly opened positions, and our interpretation is that the people currently unemployed are either not located or qualified to fill the positions that are opening up. Both of these situations require time to resolve. Some of the country's largest employers are committing to increase wages and benefits to help fill their openings. This presents a challenge to the current administration and Congress to move forward beyond rescue into recovery planning. The currently discussed infrastructure plan for America could certainly help with long-term employment improvements. One can use a nominal figure of 4% unemployment as a target for the Federal Reserve to consider a gradual end to their highly accommodative interest rate and money supply policies, beginning in mid to late 2022. First quarter 21 corporate earnings reports have been running ahead of expectations with little anticipated evidence of systemic weakness. Year over year, first quarter earnings for the S&P 500 could end up over 40%, which is strong given the circumstances, but it is hardly anywhere near the amount that would justify the leap in equities prices over that same one-year period. To put this in perspective, it would put earnings for the first quarter at about 10% over the third quarter of 2019, over a year and a half ago. Second quarter 2021 earnings are currently projected to be just a bit more than second quarter of 2019. More robust growth is expected in the second half of this year, but projections out into annual earnings for the next year, 2022, show only an 11% growth in 2022 earnings against the full year 2021. The important point is that Wall Street is currently showing large improvements over dismal figures from the first three quarters of 2020, but those improvements would be far less impressive if the COVID decline had never, ever created an earnings depression. Equities market pricing has continued to power ahead, with more volatility and pushing ever deeper into bubble territory. There are now increasing warnings being put out in the financial press as well as by indicators utilized by investment bankers that warn of a corrective environment that may be forming for equities. Recent data suggests that equities have tended to correct 10 to 12 months after the resumption of GDP growth after a recession ends. That suggests a potential window for a correction of September to November of 2021. We still concur with that concept, but can only speculate when the new market highs will stop forming. Some trigger is usually required, such as a downward surprise in corporate earnings and or many banks reducing their exposure to market excesses through the deleveraging of margin borrowers. The cybersecurity scare from the Colonial pipeline shutdown put some fear back into the markets for a few days, but it remains to be seen if that is anything beyond a temporary blip. We continue watching market performance and growing margin borrowing levels, which is our favorite tool for tracking speculative excess. Heavy margin borrowing that is synchronizing with markets making significant new highs is a likely driver for a market correction beginning soon. Last time we said this, the correction began within 3 months, and it came in 2 waves during 2018. The latest information on margin debt is from March of this year, shown in a fresh chart below from advisor perspectives. We had expected to see an increase during March, which did materialize, but at only about 1.1%, and it is likely that April will also show another small increase. Under similar margin borrowing peaks as seen in the chart, 2 blue index drops of 50% of real value followed shortly after each major correction began. A similar size drop now would take the S&P 500 index down to near 2,000. The margin debt trace has now moved above the market index trace, another early qualitative sign of increased risk. AP has been emphasizing this aspect of market risk for several months now, so we will maintain our warning about overall market risk levels. Overheated markets are characterized by higher levels of speculation. Speculation means creation of or the taking on of riskier investments, beyond what would be prudent in the case of perfect knowledge of the existing circumstances. The more speculation, the greater the risks, and vice versa. Using leverage, i.e. borrowing the funds to capitalize these speculations, exposes investors to even greater risk. If these speculative positions, consider them to be bets at this point, go wrong, huge losses can be incurred. Many investors may be wiped out completely, and those who have loaned funds for the bets will also lose. Some significant triggering event or events usually begin the cascade downward over several months. March's closing value for the S&P 500 keeps our APSI indication as red, with that index moving even further into blatantly overheated territory after a small correction in the first week of March. Another primary indication of the top-heavy nature in equities is the widening spread between the S&P 500 and a metric representing 10% of the GDP. This gap continues to grow as shown in our third chart. We see this as an indication that more and more of our money supply is being directed towards speculative activities rather than into solidly productive activities, that being goods and services. This is our form of what is more widely considered to be the Buffett indicator, and the upper curve, smooth curve, is a boundary between a warm market and a bubble zone. So take a look at that chart in our written report. There's an additional chart that we present as well, which we first showed in our March report, also courtesy of Advisor Perspectives. It literally shouts out how risky the U.S. equities markets are, using a set of 4 indicators very similar to our own in philosophy. The risks continue at all-time highs. Now, status of our other AP indicators. The APMS money supply indicator remains solidly green as the Fed continues with their expansion of the money supply, now reaching $20 trillion for the M2, up 24% since the beginning of 2020. The $1.9 trillion rescue stimulus has added further to the money supply over the last 60 days and is already being reflected in the final numbers from the first quarter of 2021. One item worthy of note is that the velocity of money again declined, as the increased money supply is still not being spent at historically normal rates. Generally declining money supply velocity has been a fact since the days just before the Great Recession over 13 years ago, and the M2 velocity, now at 1.123, sits just above its all-time low of 1.103 set in the middle of last year. This means it now takes over 10.5 months to turn over the money supply once, when it should normally take 7 to 8 months, implying a velocity of at least 1.5. Recent action in gold prices show a rebound from support levels just below $1,700 in March and a 7% move up during April, which has continued into the first half of May. Silver behaved similarly during April, moving up from the low $24 range to recent highs in the mid-$27 range. Rhodium had moved down to $23,000 per ounce, then climbed fitfully right back to its current $27,000 per ounce. Platinum continues to trade between $1,140 and $1,240 per ounce. The month-end prices for gold and rhodium keep our APPM indicator deeply into the red. The March leading economic indicators from the Conference Board again improved slightly, and for this report, finally pushed our APLI indicator into green territory after 5 months in a row at yellow. We continue to expect slowly improving LEIs to continue during the next few months. The Conference Board also improved their outlook for economic recovery and that we should expect a more robust recovery well into 2021. If these slight LEI increases each month continue, we will be solidly in green territory for this AP metric. All of this, of course, is predicated upon the absence of an equity market correction or sudden worsening of unemployment during the upcoming months. Our APYC yield curve indicator continued green, now for 3 months, the first time since May of 2018. The yield curve continues to move all on its own, maintaining a more normal shape, with the short end firmly anchored near 0%, but the long end up well past 2% for the 20 and 30-year treasuries. Small moves down showed up in the slightly shorter terms, with the 5 and 10-year yields both down less than 0.1%. The Fed still has little room to do anything on its own with short-term interest rates to further stimulate should it become necessary. If inflation pops up more than they expect, or if a further expansion of the equity bubble becomes worrisome, the Fed may be forced to react, raising short-term rates, which would likely collapse the equity bubble, assuming it does not do so under its own weight and imbalance. The first quarter of 2021 GDP grew substantially upward from its enormous decline in the first half of 2020, with the traditional measures and definitions of recession having already indicated a technical end of recession 2020 back in November of that year. Still, though, neither the NBER nor the Federal Reserve have yet to take official notice of this technical end, despite advanced projections, months-old declaration that recession 2020 had ended approximately 8 months after it began. The Federal Reserve's weekly aggregate measure of economic stability remains in a position of relative safety, but the Fed itself continues to stay with the NBER declaration of recession within all of their datasets. Therefore, our AP-FD indicator for this report remains red, now for a full year. Note that this may change soon if the NBER and the Fed finally and retroactively acknowledge the recession's end in the fourth quarter of 2020. We now maintain a cautiously optimistic stance here. The economy is coming out of its COVID coma. Restrictions on business and social activity are rapidly dropping by the wayside, and it appears there will be no fourth wave of COVID. That assumes that what is going on in the rest of the world will not push something unpleasant back into the U.S. There is a more normal political environment, which of course has both positive and negative elements to it. Market and investor anticipations of this return to normalcy may continue for many months, but increased dynamics and volatility should be expected. So in summary, we calculated that the actual onset of recession had already begun just over a year ago, a fact which was then confirmed by the NBER in June of 2020, and it became officially acknowledged by the Federal Reserve later in the summer of 2020 with their adoption of NBER's declaration within the Federal Reserve datasets. However, as we have frequently noted, the technical end of recession 2020 already occurred late in the third quarter of 2020. 3 of our 6 indicators are now in green territory, and a fourth technically should be green also, the AP-FD indicator. And we reflect this in our slightly lowered probability of another near-term recession to 50%. It would be even lower if the equities markets were more tame in their behavior. We are now entering a period in which our standard 6 indicators can be relied upon again, but still augmented by a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several more months. Those are inherently less reliable short-term indicators of recession potential than the 6 AP indicators. In our final notes, we continue to maintain that this is a very risky equity market environment with the potential for significant and protracted drops or flash crash scenarios based upon the disparities shown in our charts over the past several months. Only those with the highest tolerances for risk should be speculating in the equities markets at these levels. High speculative valuations never persist, and a return to the mean or worse becomes more likely with any new unexpected disruptive influence. The only moderating influence in this scenario is that the Federal Reserve has continued to state a longer-term near-zero interest rate environment, and that tends to fan the fires of market speculation. This situation could persist for another year, or some new black swan event could arrive to pop this bubble in short order, such as more serious forms of the recent collapse of the Archegos Capital Hedge Fund or the Colonial Pipeline cyber attack shutdown, or perhaps something else. History may repeat itself in that we could expect to experience another roaring 20s as public confidence, optimism, and spending take over once COVID is truly behind us. Despite the glossy economic reputation of the 1920s, there were 3 recessions in it, before the big one. This time, a more responsive and proactive Fed and a hands-on administration could improve our prospects for sustained economic gains over the coming decade if we can avoid disruptive political detours along the way. That's it for the month of May and our April statistics. We hope you have a great beginning to the summer with Memorial Day later this month, and we'll talk to you in the early days of June. Thanks for listening to Advanced Projections.